It is not difficult to invest in mutual funds, but it is not the same as investing in stocks or exchange-traded funds, ETFs. Some elements of mutual funds trading may not be intuitive for a first-time investor due to their particular structure. Due to previous violations, many mutual funds place restrictions or penalties on some kinds of trading operation. Hey go-getters, welcome back to The Early Investors, another profitable episode where you can learn how to become financially free. In today's video, we'll be showing you mutual funds for beginners. Want to become the next Warren Buffett? Stay with me to find out all the tips and tricks to save your hard-earned money. Before we jump into the video, make sure to subscribe to our channel for more business-related content. Let's start with the very basics. A mutual fund is a kind of asset class made up of a pool of money that many investors accumulate to invest in securities such as stocks, shares, instruments of the money market, and other assets. Mutual funds are regulated by professional money managers who allocate the assets of the fund and try to generate capital gains or revenue for investors of the fund. The portfolio of a mutual fund is structured and maintained to match the investment goals set out in its prospectus. Mutual funds offer access to professionally managed portfolios of equities, shares, and other assets to small or individual investors. Accordingly, each shareholder shares proportionally in the fund's gains or losses. Mutual funds invest in many stocks, and performance is typically tracked as the shift in the overall market cap of the fund, derived from the aggregating performance of the underlying assets. If a mutual fund is interpreted as a virtual firm, the fund manager, also referred to as its investment advisor, is its CEO. The fund manager is recruited by a board of directors and is legally bound to act in the mutual fund's best interests. The fund's owners are also mostly fund managers. In a mutual fund firm, there are very few other staff. To help select investments or conduct market research, the investment advisor or fund manager can employ some analysts. To measure the fund's NAV, the regular value of the portfolio that decides whether share prices go up or down, a fund accountant is kept on board. To keep up with government legislation, mutual funds need to have an enforcement officer or two, potentially an attorney. A simple understanding of mutual fund trading ins and outs will help you manage the process smoothly and get the most from your mutual fund investment. In essence, mutual funds are loaded. Mutual funds that have a commission, and there are no load mutual funds with no commission. A load fund is a mutual fund that comes with a fee or commission for sales. An investor of the fund pays the load to be paid by a sales intermediary, such as a broker, financial manager, or investment advisor, for his time and experience in choosing the investor's suitable fund. At the time of investment, the load is either paid up front when the shares are sold, or as long as the investor owns the funds. A no-load fund through a broker is not sold. You purchase them directly from a corporation. You'll see their ads in magazines and on websites and their businesses, stuff like Vanguard and Fidelity, and that they are primarily no-load, which means they don't charge a commission. No commission does not necessarily mean cheaper for two reasons. One is that they charge fees for mutual funds in 2 or 3 cases. At that point, all mutual funds had an annual maintenance fee depending on your balance. So let's assume you had $100,000 in there and the maintenance fee was 0.75%. It would be $750 that you were paying as a maintenance fee in the mutual fund. There is a maintenance fee on a no-load mutual fund, but you'll always have a fee. It only doesn't have a fee. It doesn't have the commissions of the 5 3/4 of the other types. So now you do have a fee. Let's assume you go back to our example of 5 3/4. Let's assume that you and that broker put $100,000 into that fund. You paid the 5 3/4 commission, so that's $5,750 you paid up front now. So the maintenance fee on that fund, let's say it was just $250 a year for 0.25% for 10 years. After 10 years, $2,500 would have been charged in maintenance fees, 250 times a year. So that $5,700 would have been paid on top of that, and now we're talking about $7,000 and some change over $10,000. No commission does not always mean cheaper. You have to dig a little deeper to figure that out, so that's the first thing. Then the second thing is with commissions, there are 2 ways that people are charging now. One is that they do the 5 3/4 upfront, and the second approach that they do is called C shares. And instead of charging you a commission upfront, the brokers can handle the whole portfolio for you. They're going to do it for 1% a year, which is not a bad deal because you have a broker to counsel you, educate you, and support you every year. Suppose you have a good broker who's interested and you can call them. In that case, you know you can see a bad news report about something because you're concerned about the stock market falling 400 points in one day last week. You can call your broker and talk to him about it. A research ad shows that you can make more if you have a good broker in your corner. You tend not to be as emotional in your decisions, so you could do the 1% deal where they charge you 1% a year and there's no commission, but they charge you 1% fee to manage everything. Still, they're at your beck and call if you need them, and if you want to put more money in, there's no fee except the next year you're going to get a 1% bill on that money that you put in on top of everything else you put in. But some people love it, and they act like that in the financial world. The people who charge 5 and 3, some of the people have a holier than thou, and act like the people in charge of 5 3/4 are cheating someone off. But let's do the math again, because these are the same two mutual funds, just two different ways to charge it in a commission, 1% to manage it, or 5 3/4 up front. So let's retake our 100,005. 3/4 is $5,750. 1% on 100,000 if it doesn't grow at all, which would be really bad, but if it doesn't grow at all, 1%, $1,000 a year, for 10 years is $10,000. Hence, even if you do the 1% with quote no commission, you pay more as long as you leave it alone. Later on, if you think to move stuff around or to buy, sell finds inside. You know you're going to pay the stinking $500 every time you move it around. So the reality is all three of these work, and if you do any of the three, you'll be okay, as long as you look at them carefully for your situation and decide. Every mutual fund is mandated by law to file with the SEC a prospectus and daily shareholder reports. Be sure to read the policy document and the necessary shareholder reports before you invest. Besides, mutual fund investment portfolios are controlled by independent agencies registered with the SEC, known as investment advisors. Always confirm before investing that the financial advisor is registered. That's a wrap to the video, hoping that these tips will help you in your journey towards success. We are damn sure that today we nursed you to make some shrewd decisions. Let us know what you think about mutual funds, and if you have any doubts, please leave them in the comments section. But before you make a move, don't forget to smash that thumbs up button if you liked it. Until next time, investors.